What's up, guys? Welcome back to the Bumpy Road to $10 million. Today, we're going to focus on how the stock market and our portfolio performed in the first month of 2026, as well as which put options I bought for my portfolio to protect me for the year. Before moving on, a reminder that this video is not financial advice, and when investing, you can lose everything. So please always do your own research. So at this point, we're 1 month into 2026. As of January 31st, the S&P was up 1.5%, and UPRO and SPXL were up 3.3% each, which is about 2.3 times the SPY return. This is, of course, less than the 3 times daily return of the SPY we expect, primarily because January was a relatively volatile month if we look under the hood a bit. For example, on January 20th, UPRO and SPXL dropped by more than 6% each in one day. Overall, though, if UPRO and SPXL keep generating 3.3% return every month this year, we would be quite happy at the end of the year, as this would mean we would earn a return of around 40%, which is significantly higher than our annual return assumption of around 28%. So when we look at the portfolio on a monthly basis, it was a fairly steady start to the year. Now, in addition to the levered ETFs, the other important element of our strategy, of course, is the put options. We covered the put options in a lot of detail in the earlier video of this series, and you'll remember that for our strategy, we generally try to buy put options once at the beginning of each year, and the idea is that in a good year, these will just go to zero over time, and we don't mind. And in a bad year, the puts will protect our portfolio through increasing in value, especially in a disaster case scenario where UPRO and SPXL both go to zero. And at a high level, we aim to buy puts that are around 70% out of the money and with a time to expiration of around 1 year. So we'll go through which put options I bought for my portfolio for 2026. And let's start with UPRO. With UPRO trading at around $116, what I did on December 31st, 2025 was buy UPRO puts that expire in January 2027 with a strike price of around 25. So this was around 78% out of the money with around 1 year to expiration. While this may sound simple, unlike buying ETFs, buying this UPRO put option did take quite a bit of time and analysis. Why? Well, buying such out-of-the-money and long-dated options is partly art, partly science. The bid and ask spreads can be quite wide for certain options, and we need to see which options provide both the best value for money and also certainty of execution on the day that we are buying. Let's look at what was available for sale on the day I bought the UPRO puts when I searched for put options expiring in January 2027 that were around 70% out of the money. For strike prices of $25, $30, and $35, which were between 70 to 80% out of the money, we can see what the bid and ask prices were on this table. Remember, we previously discussed the best price at which someone is willing to sell at is the ask price, and the best price at which someone is willing to buy at is the bid price. So it's generally okay to assume that we will be able to buy put options at the average of the bid and ask, assuming the bid-ask spread, or the difference between the two prices, isn't too wide. With this in mind, it should be clear that the best option on this table is the first one with the strike price of $25. The bid and ask spreads, shown as the percentage difference on the second last column here, are just too wide for the other options at over 150%. This means if we place a buy order at the average price for these options, it may never get filled. To quickly walk through an example, the average of the bid-ask prices for the second option here, with a strike price of 30, is 1.95. If we were to place an order to buy at 1.95, the best price at which someone is willing to sell at is much higher at 2.8. So it's unlikely that this person will come down so much to sell to us at 1.95. On the other hand, for the option with the strike price of $25, the average of the bid and ask is 1.2, and the ask is 1.3. So it's much more likely that the seller will be willing to come down slightly to sell to us at 1.2. So hopefully it's clear now that the option with the narrowest bid-ask spread will be easiest for us to buy. The other part of our calculation when determining which put to buy is what is the maximum protection we get if UPRO goes to zero. To make the math easy, let's assume we have $1,000 to allocate to UPRO puts, and we are able to buy at the average of the bid and ask prices we saw on the previous slide. I won't go through the math again because we covered this in detail previously, but have a look at the column on the right here, which shows the maximum profit in a scenario where UPRO goes to zero for each put option. For the put with a strike price of $25, we clearly get the best protection, and these options would have the highest value by a distance in our disaster case scenario. So considering these two factors, one, that we will be able to buy the $25 strike price put most easily because the bid-ask spread is narrowest, and two, that we would get the maximum protection from this same put if UPRO goes to zero, I went ahead and bought UPRO put options expiring in January 2025 with a strike price of $25. Now let's talk about SPXL. I had to do something slightly different here because of the market prices of SPXL options on the day I was buying. To start, similar to UPRO, I first looked for SPXL options with 1 year to expiry that were between 70 to 80% out of the money, which would imply strike prices of between 50 and 60, as SPXL was trading at around $220. Per this table, I found that the bid-ask spread for these options were just too wide, at between 225% and 925%. Despite these massive spreads, I still tried to buy the options with the strike price of 50 and placed a couple of orders in early January to buy at the average of the bid and ask prices. But, as expected, the orders just never got filled because the spread was too wide. So instead, I looked at options maturing in July 2026 or a lower time to maturity of around 7.5 months. For these options, the lowest strike price available to buy or sell was $100. And as you can see on this first table, the bid-ask spreads were a lot more reasonable, and for the option with the strike price of $100, the bid-ask spread was 31%. And for the second table, the maximum profit if SPXL went to zero was around $30,000 if we allocated $1,000 to this put. So although these put options expire earlier than the UPRO put options, in the event both UPRO and SPXL go to zero, we would get more money back through the SPXL options given the higher strike price. So ultimately, I decided to buy the SPXL options that were 55% out of the money with 7.5 months to expiration. Now, of course, if the market moves higher, the downside to these SPXL options is we'll potentially need to spend money to buy additional SPXL puts as these expire in July so that our portfolio is always protected. But everything has pros and cons, and I feel the peace of mind provided by these options for me is worth the cost. So overall, I bought enough put option contracts so they comprise around 2% of my portfolio. And in the catastrophic event that SPXL and UPRO both goes to zero, I would get 75% of my invested capital back. If any of this doesn't make sense to you, please go back and watch the earlier videos in this series for context. I promise it will help. Now, as of January 31st, both options were down by less than 5% each since I bought them, given the 3.3% year-to-date increase in UPRO and SPXL, which is what we expect to see. So overall, guys, as of January 31st, 2026, first month of the year, everything's going according to plan, no major surprises, and we hope the S&P 500 and consequently UPRO and SPXL keep going up, but if they go down, we are well protected through our put options. So that's it for today. I hope today's video was interesting. Please don't forget to like and subscribe below. As always, thank you for your time, and I look forward to seeing you next week.